Good afternoon, and welcome to our last panel on the market transition to UMBS. We have a very, very distinguished group of panelists. Rob Huntington, the head of pass-through trading at Credit Suisse. Gary Kane, the director, CEO, and CIO of AGNC Mortgage Corporation. Matt Joseph, the managing director and head of securitized products and rate research from JP Morgan. And Justin Monahan, a director of agency MBS at TradeWeb. So in this panel, we're going to cover a number of things. We're going to start with a set of general questions, and then we're going to move to some trading-specific issues, including TBA trading, STIPs, dollar rolls. We're going to talk a little bit about conversion, and then we're going to finish up with a couple of general questions. So with that, let me get started. On the previous panel, we talked, there's a lot of talk about alignment, and you saw the set of FHFA rules that came out last week. In particular, the maximum differential between a given mortgage in a pool and the coupon rate can't be more than 112.5 basis points, 50 basis points max servicing. Is there, what impact do you think that has on the market? Is there anything else in the set of rules that came out last Friday that you think is going to have a great impact on the market? And so why don't we actually start with Rob and just go down the aisle?
So actually, why don't we start with Gary on that one? But I think from a dealer's perspective, it's certainly been all about wax recently, and wax are certainly what has gotten the most attention.
So what I'd say is, Rob and I actually both were on a SIFMA subcommittee, that's been involved in this process for quite some time. And probably close to a year ago, we started at SIFMA to worry about wax. Most of the focus on alignment had been about prepayment speeds. But obviously, when you sit there and think about prepayment speeds, they occur a year or two, depending on the interest rate environment after the loan, after pools have been formed, interest rates change. Really, what we started to focus on are what are the characteristics that can cause issues, up front. And so this WAC issue became, sort of a theoretical issue. Hey, if the WACs were very different amongst the GSEs, then we'll see the prepayment differences, but down the road, and then we'll be trying to deal with a problem 2 years later when you see the speeds. Lo and behold, we started those discussions, via the letters to FHFA and via discussions, and then lo and behold, as many of you know, market conditions changed, the yield curve flattened, other factors came into play, and gross WACs, or difference between gross WACs and coupons, started to explode in the marketplace, making this really over the last 3 to 6 months, mainly even the last 3 months, into like a very big issue for the market. And again, it sort of started as much more of a theoretical issue. You gotta, it's gonna take a long time for the prepayment speeds to show up. Let's try to catch issues beforehand. Now that being said, look, I think there are a number of people that would have preferred a lower, cap than 112 and a half. But, we can't underestimate, or we can't, that might have been better. There were reasons why I think it had to come out here, at least for now. But this is a significant positive for the market. What it does mean is that what we've seen to date has to improve. We have to come back from there. There are plenty of pools. There are billions of dollars worth of pools that have in excess of even the cap, let alone the fact, as Mark said, the cap's gonna, the cap isn't gonna be where everything is. That's the absolute maximum for a loan. So there are billions of pools out there that wouldn't be creatable under this rule. And second of all, and it's really both rules, the 50 and the 112. So this is materially better than what we have in the current state of affairs, which is uncapped, and realistically we have a 250 basis point cap for the GSEs. So the current scenario could have gotten a lot worse. This not only caps it, it actually, caps it a little below where, recent activity has been. So it's important, it's favorable. Is it, the best that, would a lot of people have liked it to have been lower, including myself? Yes, but if you have to take a step back and say it's a lot better than nothing.
I mean, yeah, I would echo those comments. Just a couple things to add would be, since the ruling came out, we've heard some feedback from investors along those lines, basically saying this has been a problem that's been out there. Even away from UMBS, we've seen the gradual wax drifting higher, and this is a step in the right direction. I think people were expressing they'd like to see it even lower. But I think it's probably a good step for most investors. But I think more broadly, maybe one angle that hasn't been discussed as much is kind of what this means for the lending community in general. And if you think back on kind of how this industry has evolved, we've got a lot of capacity right now among lenders, and the profitability has been more challenging. So when you start introducing these types of restrictions, WAC versus pass-through rate, I think the less efficient lenders are going to find this to be a little bit more challenging. And depending on where the coupon swaps are, it might be more and more challenging to make the ROE or to actually keep a viable business. And so I think this will have an effect, I mean, not in and of itself, but it's another factor that could drive some of the less efficient lenders out.
I think echo the points that they made. I think the timing of this is pretty critical, and I think it clarified a lot of the questions that were out there between the last ruling and now, and it's important ahead of the SIPMA vote, obviously, this week. But that's pretty much our standpoint on it from TradeWeb. So.
Do you want to add
Yeah,
anything, Rob?
I think on wax in general, recently there's been less certainty in trading TBAs, and that's what you don't want as a dealer. You want certainty on trading TBAs. You want your customers to be comfortable. And so this removes that kind of degree of uncertainty. The restrictions keep everything more in line.
Well, thank you. So assuming SIFMA approves, are you ready to begin UMBS trading in TBAs for June settlement? What have you done? What more do you need to do from the system side, from making customers more comfortable?
So we're ready to trade. It's taken a few years of preparation, but we're ready to trade. But I think it's important, it's not just June for the launch, it's trading TBAs. And the TBAs will start trading at the end of this month or April. So that's our ready date.
We're ready to trade it. We have mostly external providers, really, in terms of helping us on the system side, and we fully expect them to be ready since many of them were sitting up here earlier. So I think so we certainly plan to be ready.
Yeah, I mean, I think we as a dealer are ready. I think the index providers are pretty much ready. I think maybe the areas from investors that I've heard that are not quite ready are probably the smaller investors and or maybe foreign investors are probably a little behind on all this, but I think there's been a lot of progress.
From a TradeWeb standpoint, I think we're ready as well. We've had UMBS simulation in our testing environment since November. March 11th, Monday, we will have the exchange test in our environment as well. So
Justin, one follow-up question for you. Given the role of TradeWeb in the market, you're on the front line for assessing investor interest. How many investors have signed up so far? Have there been any issues with the sign-ups? Can you sort of talk about what's been going on there?
So this has definitely been a focus of ours over the past 6 months or so. We've dedicated a lot of resources from a technology standpoint. We've had our sales team running a pretty significant client outreach, and we've dedicated a lot of time and effort in communicating the important milestones along the way leading up to go live. So we have over 350 institutions that trade mortgages on the platform. We opened up our onboarding in the beginning of February. So far, we have close to 100 request documents. Our KYC process opened up at the end of last month. We have a handful going through that process today. Communication from us has been twofold. So a lot of it has been regarding the exchange, how they're going to be comfortable setting up. It seems that for the most part, it's getting the path and the option ready. And then the other piece of it is also how UMBS is going to trade on our system. Again, we've had that in our test environment since November of last year, but people just getting comfortable with how the screens are going to look, how it's going to be disclosed that this is a UMBS TBA versus your plain vanilla Fannie Mae.
Thank you. So with that, let me move on to the set of trading issues that we wanted to discuss. The first is in terms of TBA trading. When there's a TBA market for UMBS, what's likely to be traded within 6 months? Do you expect trading of gold PC TBAs to continue after the single security goes live? Are they going to trade as that dirty word SPEK pools only? What do you expect? How do you expect the gold PCs to trade? And
So it starts off as a new origination market. The originators ask us to bid bonds, and we look at when we bid new origination bonds, we're trading them like a spec pool. We're hedging them with Fannies, with rates, with golds, and then, with the expectation that it's accepted, the investors come in and buy and sell the TBAs.
I think realistically, when it comes down to golds, at some point, and probably pretty soon after, June, I think they stop trading as TBAs, and that's not a bad thing. I mean, if you have a gold, realistically, your liquidity is going to come via UMBS, and that's what we want. That's what everyone in the market should want. So they're going to trade on swap or as spec pools. And I mean, in order to kind of have benefits from a TBA market, you need ongoing supply, you need shorts, short positions. Those things aren't going to exist, and they can't for a product that's not getting any origination. So the bottom line is, for the market, for everyone, even a holder of lots of golds like us, it should go away, and it'll be a good thing the sooner that the trading becomes specs.
Yeah, I think in terms of the conversion period and kind of how quickly people do that, I think that's part of your question. One of the earlier, questions to the audience was just about that same question. And I think roughly half of the respondents here said that they would convert within 6 months. And I guess the other half obviously be after 6 months. So I think it will be kind of a trickle effect over time of conversion, but I agree that golds will probably stop trading relatively quickly. So I think, from the one thing I'm hearing from investors in terms of converting, I would say a year ago, investors felt like they absolutely wanted to be ready for, day one to actually convert. And now I get a sense that I think people instead want to have the capability to convert, but there's not a huge rush to do so. And so I think people see a little bit of time value in maybe waiting a little bit. But I mean, based on the audience, half are going to convert within 6 months.
But what I'm hearing from all of you so far is that the minute you want to trade those gold securities, you are basically going to be under pressure to convert, or the liquidity is not likely to be there.
Yeah, I would expect golds to continue to trade, but they're going to trade like a spec. They're not going to trade like a TBA. And I think they become, without a new issue market, they become progressively more illiquid. And dealers are going to be reluctant to offer anything close to the same TBA that we've offered in golds over the years. So it quickly becomes a spec product, and that's fine because it's a cash flow product. We're used to pricing cash flow. But golds are not going to trade on a TBA basis.
Justin, do you have anything to add?
And for us, we have the Gold 30 and Gold 15-year pages on our platform. We don't intend to retire those starting in June. So if there are markets contributed to us from the dealers, they will be presentable, they will be tradable. But I'm kind of in the same camp that as supply shifts to UMBS, that there's going to be some fizzle. I just don't think it's an immediate one.
Well, let's actually talk about sort of day one of trading. Do you think that there's going to be an increase in STIP trading? How are the STIPs going to be priced? How are you going to make a How are you going to think about making a market in something you haven't priced before?
Yeah, Rob.
So, stipping has occurred over the years in TBAs, but it's never good for TBA liquidity. I don't think anybody, whether they're a dealer or investor, wants to see stipping in TBAs. Now, having said that, some accounts are going to want STIPs for concentration reasons or just because they're not as comfortable trading UMBS. But it's going to come down to an economic decision. Maybe an account wants a STIP, but do they want to pay for a STIP? And dealers, I think, will be hesitant to offer a lot of STIPs. Stipping will be done on a bilateral basis between accounts and dealers. But at some point in time, if a STIP becomes too expensive, then an account is not going to want a STIP. They're just going to either want to trade a spec or a TBA.
Just to add to that, I mean, like when you trade in when there are plenty of STIPs that investors ask for today, a whole pool STIP that some investors don't want a couple originators excluded. They want a low WAC. They want, stipping occurs, and there's a trade-off with stipping, which is if you stip, you then have to settle it with that dealer. You can't assign it. If you're not obviously going to be able to roll that, get the same roll if you want to roll it with your one dealer that you have it on. So there's a trade-off between liquidity and the benefits that the investor decides they're getting from this particular stip. And so what I do think is important is that, it's fine. Obviously, there's a new thing that someone can stip, the underlying issuer, and that could be the issuer of the underlying loan or first pool, or it could be the name of the issuer. Those are things, or practical, that we have to understand could get stipped, but they should follow the same norms as other STIPs in the past. In other words, they shouldn't be able to be assigned, they shouldn't be able to be easily transferred from one dealer to another. They should just follow the same rules that that stipping have followed in the past. And I think that's what's best, at least in our opinion, that's what's best for the market as a whole.
Yeah, I think dealers are going to probably facilitate the STIPs initially, but I think there will be a price for it. And even within a dealer, there could be a price in terms of capital charge if the long and the short can't be netted out, depending on the specifications, if it's a gold versus UMBS or what have you. And so, I think there'll eventually be a price for that. But obviously, dealers would prefer not to have a stipped market if possible and keep it as liquid as possible.
From a workflow perspective, we've supported STIPs for years on the platform. In this case, we have had expressed interest from some of our customer base that it is going to be important to their workflow. For us, to echo Gary's point, it's a bilateral agreement. It's something that could be pre-negotiated and then added to the ticket on the screen, but we want to be seen as the company that's able to facilitate that workflow, not dictate it. So if it is trading that way in the market, we want to be able to capture it on TradeWeb, and that's our stance on that.
Anyone have anything they want to add or react on what you expect from STIPs?
So I think Mike Hutchins made a good point this morning. The GSEs don't want to see STIPs either. So it gives them an extra incentive to keep their speeds aligned because they don't want to see STIPs.
Let's move on to dollar rolls. What do you expect from the May-June roll in Fannies and Freddies? And then also, do you see any permanent changes in the dollar roll market as a result of the UMBS? For example, will the market be harder to squeeze because there's greater volume? And whoever wants to take the question, just start.
I guess I'll start. In the short run, look, I mean, the concern in the marketplace is that, and I think FHFA and the GSEs, have done what they can related to alignment, but there are people that, there's the potential that people will prefer a legacy security, because of concerns of, about, something the GSE, something that may happen to the origination, down the road. And so they'll potentially want to take in TVA positions prior to June. So there is the risk of, we'll call it, squeezes or specialness if that happens in large numbers. What I find interesting is I think this WAC issue that, the fact that wax very hopefully, and I guess what we don't know is the specific timing of when the WAC restrictions come into play, but the hope is that they'll come into play soon. And if they do, the interesting thing is, as an investor, I'd love to see people take in a large amount of existing securities and basically clean up the highest WAC pools that are out there now, and then let UMBS look cleaner with the combination of the new STIPs and probably lower average WACs. So I think some of the things that have been done, the monitoring of quartiles, the WACs, should prevent that activity. But I think that's the biggest thing to look for short term. And I'll just get to the a quick answer on the long term. I think you can expect to see less specialness in small coupons due to increased float. So people could argue that certainly in off-the-run coupons, I think there have been some great roll opportunities periodically. A lot of times those are manufactured, but I think you won't see as many of those. Okay, but in the big production coupons, it's very arguable because practically speaking, the universe will be bigger and it will allow for more short activity than people have been comfortable implementing. So I think that it's clear on the fringes to me that over time you would see less specialness, but I think in the main mid coupons, production coupons, it's a little less clear because history shows the more liquid a contract is, the more short activity is possible, and mortgages are really one of the only spread products that you can really short. And I think to the extent that we have more liquidity, then rolls could trade well.
Yeah, I think the May-June roll, well, I mean, it's just a moment in time, but I think the May-June roll will probably be relatively stronger, just reflecting the weakness in June. But then I would agree that over time, the longer term outlook is probably less roll specialness, less ability to squeeze those smaller coupons, that we're more vulnerable to that type of stuff. And I think it'll be easier, with a bigger float probably to provide liquidity in some of the coupons. Conversely, it'll be more difficult to generate excess return through dollar rolling if you're an investor.
Bob or Justin?
So I guess to echo Gary's point, I think May, June, there'll probably be some degree of specialness as accounts in both Fannies and Golds look to take in some specs, but there'll be a level where accounts will roll, particularly when you're talking about, as Gary said, potentially kind of cleaning up the higher WACs. That'll be an incentive to kind of go both ways.
One thing I want to point out from a screen perspective on TradeWeb that will be different. So we'll obviously distinguish between Fannie Mae in June to a new security description Fannie description in May to a new security description of UMBS in June. But we're also going to be introducing the cross-month product swap, so gold to UMBS on the screens. We know this is something that's going to be offered with our interdealer counterparty, our participant with DealerWeb. So depending on the markets, if there are markets out there, they are sent to us by the street, we will present those. But it's more so an easy way for customers to launch that cross-month switch on the platform.
Thank you. So let's actually turn to conversion. We all saw the poll earlier in terms of how we think the gold, in terms of the audience's view on how the gold PC exchange will roll out. Who do you think is likely to convert first? And do you have any other comments on the poll?
So an account who has deliverable pools, something close to cheapest deliver, is going to be the most likely candidate to convert, someone who's going to want to trade UMBS in the near future. If an account, in our view, has more spec pay-up related pools, they're going to probably take more of a wait-and-see approach. So in that respect, from that account's respect, it'll be more of a gradual transition to conversion. Conversion's one factor that's important for the success of UMBS, but it's not the most critical factor. But building up a float over time and getting more pools converted into the float is, one aspect that will drive success.
Yeah, I mean, I think that, I would agree with Rob. What I would say about, like, from our perspective, if you have a pool that you could very easily trade into or will deliver into a TBA type trade, given the time delay, to actually get a conversion, if it's something that imminently you could trade, you theoretically should just convert it. With the other stuff, there isn't necessarily a harm in converting it unless there is, the risk that, there becomes a short in golds or somebody needs a gold for some reason, and a lot of conversions have already occurred. So, there is some argument that you could make for optionality to keep it unconverted. So I think when thinking about success for the liquidity, down the road, I would say conversion volume is a nice positive to the extent that what's being converted is something that could be delivered and used, in the market. But if, it would be, as an example, like if Freddie had, or FHFA had decided they wanted a big inducement to get people to convert, getting someone, let's say like AG&C, who has specified pools with a 1.5 pay up to TBA, and getting an inducement to convert that, serves no purpose, because those pools aren't going to help liquidity. Now, we might choose to convert them if it's easier to mark, them in the future or whatever, or if we want to sell them. But I don't think we'll be in a rush. So, I mean, that's sort of how we're thinking of it. Anything that's TBA-like, that we could use right away, we'll probably go ahead and, convert. Anything that's, kind of further from being delivered, we'll probably wait unless there's some compelling reason, to do something different.
Yeah, I mean, that's a good description. I think looking at it from the investor dimension instead, I think those investors who value immediate liquidity are probably going to convert soon too. So that would be dealers and hedge funds, so people who value that liquidity the most. Who's going to value the least? Probably foreign central banks, bank HTM portfolios, those types of investors who have no intention of trading in the near term, I would think.
Matt, are investors still facing, are there hurdles that certain investors are facing in doing conversions that you're aware of?
I mean, from what I'm hearing, I'm sometimes surprised by, some of the very specific minutia that people are still struggling with in the back office. I mean, I think the good news is you don't have to be fully ready on day one, but I think people are still some investors, I don't want to speak for the full investor base, but from what I'm hearing, I think some people are still working out kind of exactly how the exchange goes, what's the time frame. We've had conference calls with our back office and investors and us, and group calls on dealing with some of this stuff. So I think people are making progress, but it's not uniform across the investor base. So I think it's that, and I think, so it's mostly, from what I can see, mostly back office / mechanical issues, and then maybe a little of still getting their own investor approval, to own these types of
Do you have
schemes.
any idea how large a factor the latter is in terms of sort of certain fund managers getting their own investors to approve?
Well, I know it's been an issue. I think it's easier to probably deal with than some of the mechanical issues. I think it's still out there for some guys. That's all I can say.
But the mechanical issues are real in that, like, even though it's not an event, whatever, even though the tax treatment and accounting, has been kind of worked out, so to speak, your system doesn't necessarily know that. You have to overlay to ignore this transaction, blah, blah, blah. So people aren't just naturally ready, okay? They need to actually go through a process by which they figure out how this is going to show up in their system and how they need it to work. So, I mean, again, it does, even for a typical, buy-side firm, but you have some work to do, and you have to go through a testing process and so forth.
And I think specifically, I should have mentioned the also tracking the percentage of Freddies versus Fannies over time. That one is particularly, I don't know, comes up a lot with some of the money managers that we've spoken with.
Justin, do you have anything to add?
Yeah, I think the most common question on the calls we've had with our accounts is everyone asks, what's everyone else saying? So there might be a little bit of a bandwagon effect up front if they start to see some volume reports of X amount has been converted. But I think at the forefront, you might see some test trades go through just to make sure that everything works correctly and that they know they have that optionality if needed.
Yeah, I guess I would add that it's helpful that there's now 2 different options for conversion, the Freddie option and the TradeWeb option, because I think each option will suit different investors based on their needs.
Do you view conversions to be critical to how UMBS will trade? I mean, I think, Rob, you made a point earlier that it's important, but it's certainly not the most important factor.
I think it becomes, as new production comes in, it becomes less of an issue, but I think it's important. It's an important factor in the early months of UMBS. You want to see as many conversions as possible, so you start to build up a float. I think the question you asked Mark Hansen about what happened in the 90s with the gold conversion. The problem is with that, one of the many problems is that not enough market participants converted initially, and so the float didn't build up, so dealers weren't comfortable kind of making markets back and forth.
I mean, I agree. What I would say is the volume is less important than people being able to, you know, seamlessly do it, whether it's their operational issues and feeling comfortable, because the liquidity can still be provided by a unconverted portfolio as long as people are comfortable exercising that option if a roll gets special or if something happens. So I think this scenario, having lived through the 90s one, this scenario is different than that just from the start, given that you're sharing the liquidity with another product, and there's existing product in a sense even without a conversion. But that being said, I think everyone would agree that it's certainly going to help give from the outside, it'll look more liquid, and I think people will be more comfortable if they see conversion volume. So while theoretically I'm not really that bothered by low conversion volume, I think, that being said, it's probably not the desired outcome.
Right. I mean, if you think about the extreme case where nobody converts and still nobody's going to, a month go by, it's going to be like, that would be a concerning issue, I think, for the psychology of the market, but I don't think that would be the case.
And talking about market psychology, would it make any difference if the Fed converted its gold PCs immediately?
I mean, it's probably helpful just from a signaling perspective or whatever. I mean, I think people will immediately figure out that, that doesn't add a lot to liquidity, but I think it just gives the program kind of an official stamp. So I think it's a net positive.
They just have to be careful not to hog up the total capacity, because I think there's a certain daily limit. So I think they don't want to be too aggressive about this, or nobody else will be able to get in. But yeah, it would be a sign of support for the program.
So how would you define success in UMBS, and how would you measure it?
So from my perspective, you start off with accounts. You want every type of account trading the product, and that's both domestic and overseas. Like, winning the hearts and minds of the overseas investors is very important. It's execution. You want it executed just as quickly, as efficiently as the old TBA. Bid offer, you want bid offer as tight as the old TBA, and that may take some time to get there, but that's eventually where you want it to get to, and you want it to trade as often and as regularly as the TBA. You want TBA volumes to be just as high.
Well, it's interesting, as one of Rob's customers, it's interesting that he's much more concerned about the overseas ones. And I'm glad to see that he wants tight bid offer spreads. That's a positive from the investor side. But I mean, look, I think those are the metrics. And again, practically speaking, a lot of people have said they want liquidity to be similar to what we've seen, you know, to date on, and I think that's implied on Fannie's. And I think big picture, you know, the end objective should be that it's a larger market. It should be more easily shortable, and I think you won't see the fringe fails, you know, like these big fails on fringe coupons going forward. So I think those are, you know, the logical kind of issues or things that you could expect over time, and you know, and then on the roll market, again, you won't, you know, I think that there's there's different views as what's success, but I think some specialness is good for the market over time. And so, you know, if I think you'll need a consistent growing short base over time to maintain the specialness. It'll be interesting, you know, to see if that happens.
Yeah, I would say there are probably 5 different metrics that you could look at for success here. Most of them short term, but I think there's a key long-term metric here as well. I mean, first you can look at, we kind of touched on these, the outstanding balance that's converted, you know, over time. A second one could be how much volume of UMBS trading is there. A third one could be how much of it trades without a STIP. That would be a nice metric. The fourth one is, can Freddie Mac actually originate securities, or, you know, originators go through the UMBS product to eliminate the map pricing, et cetera, which will clearly happen. And I think the fifth one, though, which is more long-term, is, which I think is theoretically what motivated this whole project in the beginning, which is, will this be an important and successful step towards GSE reform? You know, towards a broader platform whereby you can have multiple guarantors and, you know, have a single security that can be, you know, issued into and such. And so I think only time will tell on the fifth one. I think all of us in the room have been focused on the first several, but I think over time we'll find out about number 5.
Justin, anything?
Yeah, I think healthy volumes for us, you know, given our market share as a vendor in the industry, keeping, you know, the same number of participants and growing that number, and then having us, you know, have the appropriate tools in place to, one, ease the transition, but then also, you know, give our customers access to the liquidity they need down the road in a streamlined fashion.
We've got a lot of very good metrics, and but pretty much of a uniformity in how you define success, which is kind of interesting. One final question. Do you have any thoughts on what can be done to ease the transition to a single security? Anything that can be done that has not yet been done?
I'll just reiterate something I mentioned related to an earlier question. The sooner you know, the new WAC restrictions go into play, because that's, you know, the announcement said that they'd be implemented later this year. I think the better, for the reasons we talked about, which is, you know, we stopped producing 125 basis point, you know, pools with 125 basis point WAC differentials. It gives people less incentive to, you know, to take in securities up front. I think that would help a lot. You know, and then you know, and then to kind of begin or set up, you know, some of the additional monitoring processes that, you know, are discussed, such as industry, you know, forums are at, like where prepayment speeds are, you know, where there's a discussion on that, and some of those things have been talked about. But I think other things like that give credibility to the alignment, you know, discussions as well.
Yeah, I think transparency on the alignment front is a big question that investors have. I mean, I think I have faith that it's going to happen, and it's already in process. But I think that's probably the key issue. Yeah.
Rob or Justin, anything?
I think a lot for us. I mean, a lot of our customers have done the testing on our platform, and they've made sure that post-trade everything seems to be working fine. So I think from an operational perspective and from a workflow perspective, a majority of our client base is comfortable. There's still some questions on the outside in terms of the exchange, but for us, I think we feel confident.
So I think, to echo what Gary said, that implementing the WAC guidance and seeing this end of kind of drift upwards in WACs and seeing lower WAC pools start to trickle in will be a positive effect.
Oh, well, thank you. And with that, I want to open it up to questions. Yes, there's one all the way in the very back.
Thank you. This one's directed mostly at Matt, but I guess all of you could answer this. It's a bit of a hypothetical, counterfactual. Do you foresee any major changes in prepayment modeling in our market over the next year or so that would not have otherwise occurred were it not for single security? And if there are no major changes to modeling, do you see that also as a point of success, that we're just kind of moving along in the same path, just with a little bit larger and more liquid market?
Right. Well, I think, first of all, there definitely going to be, this may not be exactly modeling, but there's going to be a lot more complexity in the reporting of prepayments. So we're not going to just have a gold report. We're not going to just have a Fannie report. There'll be a UMBS report, and there'll be multiple levels of look down. So I think that part of it will definitely change directly because of this project. In terms of the specific, like the loan level modeling, I don't think that will change as dramatically. I mean, I think the WAC compression, WAC minus pass-through rate compression will affect prepayments, but on the other hand, it's something we would have captured anyway through just the WAC being fed through the model. So, I think the one, the last thing I'll just say on this is, to the extent that the alignment experiment doesn't work and we don't have, let's just say investors' fears are actually realized and we don't have the convergence of speeds to a reasonable level, but it actually ends up such that all loans go much more refinanceable. S-curves end up steepening a lot. Then yes, that would be something that would be a direct result of this process. It's not my prediction, but it's a possibility.
Just out of curiosity, when do you intend to start putting out your much more detailed prepay reports? Not that you've had a lot of time to gear up for it.
Well, I mean, hopefully by June. Hopefully. Don't hold us to that. But
Of which year?
good point. Don't expect that.
Any other questions? Yes.
Hi, Louis Perwin from Freddie Mac. Thank you for your comments. I really got a lot of insight. And my question is related to STIPs. Obviously, you all said, no STIPs are better for the market. They're going to be expensive to put on. But the people in this room are generally the people who have sort of stood with single security or are willing to speak at a conference about single security. Have you heard from maybe people who are more skeptical about the project, who intend to potentially put on STIPs, or either due to preference or name limits on securities?
I'll start. I mean, absolutely. I mean, there are people that have, there are, investors out there that may prefer one GSE or the other, and I mentioned that earlier. And it's very possible that, they'll choose to STIP trades, and then in that case where they're worried about, let's say, the prepayment speeds of one of the two GSEs, they'll be STIPing, or they would want to STIP the underlying first issuer of the pool. But then it's interesting because then there are other people that are more from the 817H perspective, want to know exactly who their issuer is, and they might just separately STIP one GSE, but they won't care who the underlying issuer is. They'll care who the last issuer, the name from a concentration limit perspective is. So I think the market should expect that kind of activity. The question is how much? And again, I think it's important that, investors have always had reasons to STIP certain things. There have been times when certain originators have been STIPed out, so to speak. And this activity is going to come and go, and it's actually not necessarily bad for the market over time if it's not done too much, okay? And so the question is, has FHFA and the GSEs done enough to kind of reduce the incentives? So there's some activity periodically of this, and there may be some right up front. But can the market get past that? And does that end up being relatively temporary and along the same lines of stipping that we've seen in the past? And again, I'm optimistic that we'll end up getting to that point. And I think it's one of the reasons why I think that if stipping is made too easy, where you don't pay the cost, so to speak, of what you've paid in the past to stip something, then I think then it has a greater risk of kind of being disruptive during the transition.
Anyone want to add anything to that?
Well, I think we have heard that I think some investors are adamant that they're going to be stipping on day one, and I guess we'll see how willing the dealer community is to accommodate that. So.
With that, I'd like to thank this great group of panelists. Thank you very, very much. Great job, and appreciate being here today.
Thanks.